The Ukraine-Russia conflict is creating havoc not just on field but across financial markets as well. Equities, including Russian stocks, have cracked on the bourses, and energy prices are flaring up on fears of choked supply chains. While this may have already eroded billions of dollars of investor wealth, the crisis is far from over. Global index providers MSCI and FTSE, for instance, are proposing removal of Russia from their indices. Earlier this week, MSCI sought fund managers' feedback on the current level of accessibility and investability of the Russian equity market. It has also sought feedback from market participants on the appropriate treatment of the Russian equity market within MSCI indices. This includes the potential reclassification of the MSCI Russia indexes from emerging markets to standalone market status. Previously, FTSE had issued a note highlighting concerns around Russia. Earlier estimates suggest that removal of Russia from these two indices may lead to billions of dollars of outflows from the country, with some portion getting into other emerging markets. A back-of-the-envelope calculation by IIFL Institutional Equities said that if these FPI investments are directed towards India, there could be aggregate inflow of over $2 billion. This is because India's weightage in the MSCI EM and other widely tracked indices will edge higher. As of Feb 25th, Russia's MSCI EM weightage stood at 2.66%, 8th highest. Meanwhile, China and Taiwan topped the list with weightage 22.55% and 15.86%. India has third weightage of 12.25%. To be sure, these calculations are based on last week's weightages. The current inflows, however, may be lower than this as the ongoing market rout might have reduced Russia's weightage. Edelweiss Securities expects the inflows to be distributed in index heavyweights like Reliance Industries, Infosys, HDFC, ICICI Bank, and TCS. That said, analysts caution that it's too early to cheer as Russia's removal is easier said than done.
Given that Russia has already put a ban on selling by foreign shareholders, it looks almost impossible for the index funds to be able to sell the Russian stocks, even if the weightage of Russian stocks is brought to zero in the MSCI EM index. Therefore, actual execution looks far-fetched, and taking any position on this basis is purely speculative. There is also a high likelihood that eventually peace will prevail through diplomatic channels, and the removal of Russian stocks from international indices may not happen at all.
Trust Plutus Wealth's Vineet Bagri says other global headwinds may also restrict FPI flows into India.
The current weight of Russia in the MSCI Emerging Market Index is about 2%. This entire 2% is at the moment illiquid because of central bank actions at both ends, whether it is in Russia or in the Western world. So investors may not really be able to realize this money immediately. We also have to remember that in the last few months, FIIs have been net sellers in India, selling at an average $1.5 billion per week. And even if this money was to be reallocated across the index, at best it would cause a reduction in this heavy selling by the FIIs, may not really tantamount to new buying. In this scenario, we also have to remember that the overall dollar is strengthening against all currencies. You can see that in the dollar index. That is happening primarily because of tightening of liquidity by the US Fed Reserve, high inflation in the US. In light of all this, I don't think there will be any major impact of the removal of Russia from the MSCI Emerging Market Index.
Therefore, even if MSCI and FTSE decide to remove Russia from their global coverage, the step may only restrict FPI selling in India. Investors will therefore keep a close watch on this development on Thursday. That apart, news around Ukraine-Russia conflict, global energy prices, weekly F&O expiry, services PMI data, and stock-specific move will sway the indices today.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.